Topic introduces credit risk and explains its importance in fixed income investing. Credit risk refers to the possibility that a borrower will fail to make required interest or principal payments according to the terms of a debt obligation. Unlike interest rate risk, which affects bond prices through market yield movements, credit risk arises from deterioration in the issuer's financial condition or economic environment. Investors require additional compensation, known as a credit spread, for bearing this risk. Understanding credit risk is essential because it directly influences bond pricing, expected returns, portfolio performance, and the overall stability of fixed income markets and financial systems. The program identifies two primary components of credit risk: probability of default and loss given default. Probability of default measures the likelihood that an issuer will fail to meet debt obligations within a specified time period, usually expressed annually. Loss given default represents the proportion of the investment expected to be lost if default occurs. Loss severity depends on factors such as collateral value, seniority ranking, and recovery rates in bankruptcy proceedings. Together, these components determine expected loss, which can be expressed as the product of probability of default and loss given default. Analysts use expected loss estimates to evaluate whether bond yields adequately compensate investors for credit-related risks. Recovery rate is another important concept in credit analysis. It represents the proportion of a bondholder's claim expected to be recovered if the issuer defaults. Recovery rates vary significantly depending on the bond's seniority, collateral backing, legal protections, and the issuer's remaining asset value during bankruptcy or restructuring. Senior secured bonds generally exhibit higher recovery rates because investors possess priority claims on pledged assets. Subordinated or unsecured bonds typically have lower recovery prospects and therefore carry greater credit risk. Since loss given default equals 1 minus the recovery rate, investors carefully assess expected recovery values when evaluating fixed income securities and determining appropriate credit spreads. Credit spreads represent the additional yield investors demand above a benchmark risk-free rate to compensate for credit risk. Government securities are often used as benchmarks because they are considered relatively free of default risk. A bond's credit spread approximately reflects expected losses arising from default probability and loss severity. If actual spreads exceed estimated expected losses, investors may be more than adequately compensated for credit risk. Conversely, narrow spreads may indicate insufficient compensation for default exposure. Credit spreads are influenced not only by issuer-specific fundamentals but also by market liquidity, investor sentiment, economic conditions, and broader financial market volatility. Credit rating agencies such as Standard & Poor's, Moody's, and Fitch play a central role in fixed income markets by evaluating issuers' creditworthiness. Ratings provide standardized assessments of default risk and help investors compare bonds across sectors and markets. Investment-grade bonds generally have lower default risk and narrower credit spreads, while high-yield or speculative bonds carry greater risk and higher expected returns. Although ratings are widely used, the program emphasizes that they are not guarantees of performance and may lag behind rapidly changing market conditions. Analysts should therefore supplement ratings with independent credit analysis rather than relying exclusively on external assessments. Macroeconomic conditions significantly influence credit risk and yield spreads. Economic expansion generally improves corporate profitability, employment levels, and government fiscal positions, reducing default risk and narrowing spreads. During recessions, declining revenues, rising unemployment, and financial stress increase the likelihood of default, causing spreads to widen. Interest rates, inflation expectations, and monetary policy also affect credit markets by influencing borrowing costs and economic growth prospects. Because credit conditions are closely tied to the business cycle, investors monitor economic indicators carefully when evaluating fixed income securities and adjusting portfolio allocations across different sectors and credit quality categories. Issuer-specific factors are equally important in assessing credit risk. Analysts evaluate profitability, leverage, cash flow stability, liquidity, competitive position, and management quality when determining an issuer's ability to meet debt obligations. Companies with strong balance sheets, stable earnings, and diversified operations generally exhibit lower credit risk. Conversely, highly leveraged firms or issuers operating in cyclical industries may face greater vulnerability during economic downturns. The structure of debt obligations, including secured versus unsecured status and covenant protections, also affects credit quality and expected recovery rates. Comprehensive credit analysis therefore combines both quantitative financial metrics and qualitative assessments of business and industry conditions. Topic ultimately demonstrates that credit risk analysis is fundamental to fixed income investing and portfolio management. Investors must evaluate the probability and severity of potential losses while determining whether bond yields adequately compensate for default exposure. Credit spreads, ratings, recovery rates, and macroeconomic conditions all influence bond pricing and expected returns. Effective credit analysis requires integrating quantitative financial analysis with broader assessments of economic, industry, and issuer-specific factors. By understanding the drivers of credit risk, investors can make more informed decisions regarding portfolio diversification, risk management, and relative value opportunities within corporate, government, and structured fixed income markets.